There's a very old story about two financial economists walking down the street. One is a finance professor from the University of Chicago, the birthplace of what is called the efficient market hypothesis. In this lecture, we'll discuss the hypothesis in detail, but in brief, it essentially says that competition among market participants prevents people from getting a free lunch or making excessive amounts of money. The other economist is from Wall Street, a place presumably that thrives on making excessive amounts of money. As they talk, they pass what appears to be a $20 bill lying on the sidewalk. In a moment of uncharacteristic generosity, the Wall Streeter points at the bill and says to the professor, "Go ahead." The professor, looking quizzical, says, "What?" And the Wall Streeter says, "Aren't you going to pick up that $20 bill?" The professor says, "Of course not. If it were a real $20 bill, someone would have picked it up already." And with that, the Wall Streeter bends down and picks it up. Later, they stop at a nearby sandwich shop for lunch, and the professor asks, "Aren't you going to buy me a sandwich with the money that you found?" And the Wall Streeter replies, "No, there's no such thing as a free lunch. For you, at least." In this lecture, we will discuss the extent to which you can make money actively trading in the market. As we discussed in Lecture 2, there are a number of ways in which you can be active. You can be active trying to time the market as a whole, taking money out of the market when you think it will do poorly and putting it into safe investments like T-bills. You can also be active by reallocating money across sectors or industries, taking money out of the sectors you think will do relatively poorly and putting it in those you think will do relatively well. And you can also be active by stock picking, by trying to find individual securities that you think will do better than the market as a whole or as the sector or the industry that they're in. In this and the next lecture, I want to talk to you about how often you can expect to find $20 bills lying around. While the Chicago professor may seem silly for not picking up what was obviously a $20 bill, the question you really need to ask is whether it makes sense for you to work through lunch or go for a walk during lunch. And if it does make sense for you to go for a walk, should you walk down a busy main thoroughfare or a less well-traveled side street looking for $20 bills? One way to summarize the intent of the whole course is that it seeks to develop techniques for judging whether a potential investment is a good deal or not. With this intent, the course focuses on essentially a two-part process. First, determine how best to characterize risk. Second, given a good measure of risk, determine whether a security is a good or a bad deal in terms of its ability to, on average, generate returns that will compensate you for its risk. A good deal is one in which the market price of the security is below its value, and a bad deal is one in which the market price is above its value. That is, anything is potentially a good deal if it's cheap enough, and everything is potentially a bad deal if it's too expensive. In this and the next lecture, we'll examine the evidence on whether or not the premise of this process is folly. The actual process may be folly if the specific techniques people use to measure risk and calculate value are not very good at identifying good and bad deals. But the premise of this process is that there are good and bad deals in the market, that there are $20 bills laying around to be found. Notice that, regardless of what we find in this lecture, it will be good news. If we find that there are no good or bad deals to be found, then the good news is that all deals are just right. That is, prices reflect true value. Thus, you can invest, say, in order to save for retirement without worrying about whether you're being taken advantage of. And if we find that there are good and bad deals to be found, then that's good news that you may be able to earn a return on any effort that you want to put into finding those opportunities. If there are good and bad deals, then the only possible bad news is, in order to not be taken advantage of, you have to spend a significant amount of effort protecting yourself from being exploited. And in this lecture, we'll examine that possibility too. Just given the fact that there are 19 lectures that follow this lecture, you might guess that there must be $20 bills laying around. Thus, there'd be no reason to go through a bunch of lectures on techniques for finding them. This logic is flawed, however, and here's why. Even if you cannot find $20 bills laying around, there is a decent but not excessive return to be earned simply by investing. In the story of the financial economist walking to lunch, $20 bills are meant to represent money that you don't have to earn. From now on, I will refer to any money that you get in excess of what you should earn as an excess return. I keep saying earn. What do I mean by earn? How do you earn returns? And how much should you earn? Well, at any given time in financial markets, there are a bunch of people who have ideas, but not enough money to implement them. At the same time, there's a bunch of people who have some money that they could either consume or save. Since most people are impatient by their very nature, the people with the money now need to be induced to save. If they're going to give up some consumption today, they need to get more consumption in the future than they give up today. That is, they need to get interest on their savings. They earn that interest by foregoing consumption. You could also say that they're earning interest by providing a service. By giving up something of value, current consumption, they're providing something of value to the people with the ideas, capital to implement their ideas. In addition to earning a return, giving up the consumption now versus consumption later trade-off, the people who save will also need to be induced to bear risk, the risk associated with some of the ideas turning out to be good, while others of them turn out to be bad. The riskier the idea, the greater the return savers need to be induced to save by investing in that idea. A fair return is a return that balances the amount savers need to be induced to save and the amount people with ideas are willing to pay to fund their ideas. So savers earn a fair return by bearing risk and providing capital. An excess return is one that is in excess of the return needed to induce someone to invest. If you like ice cream enough to eat it without whipped cream, an excess return is free whipped cream on your ice cream. So what does this have to do with the 19 lectures that follow? Before we investigate whether there are $20 bills or excess returns to be had in the market, the point I want to make is that even if there are no excess returns, there are still many things that you need to think about and do with your investments in order to ensure that you get just even a fair return. Many of the 19 lectures that follow will concern these types of issues. More specifically, even if there are no excess returns to be had in the market for securities, there may be inefficiencies in the market for financial services. Much of the material in the course will put you in a position to make sure that you can get a fair share of your returns if you decide to delegate the management of your investments to a portfolio manager. And if you invest on your own, many of the issues we discuss subsequently will make sure that you don't make mistakes and miss opportunities for even fair returns. Furthermore, the market is not very sympathetic. It won't compensate you for any risk that you might be taking mistakenly. So it's important for us to figure out what risk is so you can avoid it when necessary. So let's look at the efficient market hypothesis in detail. We'll do this in 3 steps. First, I will define the hypothesis exactly. Second, we'll explore what the hypothesis implies with respect to both security price movements and the ability of various market participants to make excess returns. Third, we'll examine the empirical evidence on whether the implications of the efficient market hypothesis hold in the data from actual markets. This third step will be done in Lecture 7. The efficient market hypothesis, or EMH for short, is that financial markets are efficient. What does efficient mean? There are 2 senses of the word, one of which is what the efficient market hypothesis refers to directly. The other meaning sometimes is considered as an indirect implication of the first meaning. The EMH is directly related to informational efficiency. The market for a particular security is said to be informationally efficient if all available information that is relevant with respect to the future value of that security is reflected in the current price of that security. The key thing here is that the current price reflects everything available of relevance to future value. This means that if there is information available now that the profitability of a particular company is going to increase significantly in 2 years, then the current stock price will reflect that future increase in profitability now. An efficient market for a security is one in which newly available information is also reflected very quickly. If it takes time for the new information to be reflected in the price of a security, then there's a significant amount of time in which the price of that security does not reflect that available information, which would be a violation of the EMH. There are three forms of the EMH which differ in terms of what is considered available information. The weakest form is the so-called weak form of the EMH. It is the weakest form in the sense that it is the easiest form to satisfy. That is, it is the form with the fewest conditions. The weak form states that any information that can be gleaned about future prices from past prices or returns will be reflected in the current price. That is, it defines available information as including only past prices or returns. This is a weak form, since while it may be hard for many people to know about and understand the implications of the firm's strategic plan, say, it should be easy for people to get past price information. The principal implication of the weak form is that there is no predictable pattern in returns. A predictable pattern might be something like, after the market drops more than 1%, 90% of the time, the return the next day is bigger than the average return over the previous year. This is a violation of the EMH because if one could predict with reasonable accuracy, in this case 90%, that the price is going to be significantly higher tomorrow, then the price today should be higher in anticipation of this. If the above fact is true for a particular security, that fact is typically taken as evidence that, on average, the market for that security overreacts to bad news. And following that overreaction, it corrects itself the next day. If the market overreacts to good news too, then the return the following day, after a large positive return, will on average be negative, overturning some of the prior day's reaction. That is, what goes up comes down, and what goes down comes back up. If the market were to underreact on average, then following good news and a positive return, there would be another positive return the next day on average. And following bad news and a negative return on that day, there would be another negative return the next day. These cases are also violations of the weak form of the EMH, since the average price level the next day is not reflected in the current price. If investors know that the price will be higher the day after a good news, then why don't they bid up the price today? And if they don't, then the current price does not reflect that expectation, which is a violation of the EMH. Thus, the weak form of the EMH implies that you can't time the market by trading in advance of predictable price changes. It is sometimes said that the weak form implies that price changes are unpredictable. Equivalently, it is also said that under the weak form, prices follow what is called a random walk. I will define what a random walk is shortly, but I must disclose first that the unpredictable price change and random walk implication is really only an implication of the weak form in markets where no one cares about risk. That is, these features only hold in markets populated solely by risk-neutral people. Risk-neutral people are those who only care about average return, not the possible variability in the return. Such people view the following two securities as equivalent in terms of returns. Let's say security A has a 50-50 chance at a 10% return and a 20% return for an average return of 15%, while security B always returns 15%. Risk-neutral people are neutral to the risk. All they care about is the average return. So although there is uncertainty about the return that will occur for security A, since A has an average return that is the same as the average return for B, a risk-neutral investor would view them as equivalent as an investment. A risk-neutral person would also prefer security A to, say, security C, which generates 14% always. Thus, a risk-neutral person always looks solely at what the average return is to rank alternative investments. So before we think about the more realistic but also more complex case in which people care about risk, let's think about how the weak form would manifest itself in the simpler case of a market with only risk-neutral people. Once we understand that, we can more easily see the added impact of people caring about risk on the implications of the weak form on the EMH. Let's start with a little thought experiment. In a market with just risk-neutral people, what would be the average return on any security? It would be the same for all securities. Why? Well, let's consider what would happen if there were just two securities in this world, say security A and security C from before. Although security A's return is uncertain, no one cares. Since it has a higher average return than C, 15% versus 14% for C, everyone would like A and dislike C. As a result, everyone would buy A and sell C. And as they buy A, the price of A will rise, and as they sell C, the price of C will fall. As the price of A rises, the average return on A will fall, and as the price of C falls, the return on C will rise. To see this, let's say that we have the price of A is currently at $10. In the event that the return on A is 10% over the next period, then the price of A will be $11 at the end of that period. Similarly, if the return over the next period turns out to be 20%, then the price of A will be $12 at the end of the period. If people want to buy A at the current price, then the price will rise, say to $10.05. If so, then the price of A turns out to be 11 at the end of the next period, then the return is going to be what? It's going to be 11 minus 10.05, all of that divided by 10.05, and that's a 9.45% return. If the price turns out to be $12, then the return is 12 minus 10.05, all of that divided by 10.05, and that's a 19.4% return. The average return then is 0.5 times 9.45%, plus 0.5 times 19.44%, which is equal to 14.43%, which is lower than the initial 15%. So similarly, if people were to sell C, the current price of C would fall, which would make the return rise. By buying and selling A and C, what they're going to do is they're going to make these returns adjust. And people are going to be buying and selling C until the returns actually end up being exactly the same. Thus, in a risk-neutral world, the average returns will be just the risk-free return, which is the return that induces people to give up current consumption in exchange for future consumption. That is, the risk-free rate is the rate that only reflects the time trade-off, not the risk trade-off. Since no one cares about risk in this risk-neutral world, all interest rates and returns are the same. At very short intervals, say over a day, the return you need is typically very small. For example, if the annual return is 14%, which is huge, by the way, then the daily return is about 5 basis points, where 100 basis points equals 1%. That is, 5 basis points is 5/100ths%. Very, very small. When the risk-free rates are on the order of 1%, as they were following the financial crisis in 2008, then the daily return is 3/100ths of a basis point. That's very, very, very small. In fact, hardly discernible. So if the daily return on all securities is essentially zero on average, then the frequency with which prices rise will essentially equal to the frequency in which they go down. The changes in the price levels are due to the arrival of news. Since news is by the very definition unpredictable, else it's not news, it's olds, the price changes must also be unpredictable. Okay, so this is consistent with the image of someone taking a random walk, whereby every step is independent of the previous step. To see what I mean by a random walk, consider my position in the front of the studio here on the carpet. If I start in the middle and then I flip a coin, if it comes up heads, I'm going to take one step to the left. If it comes up tails, I'll take a step to the right. Where I go from there is going to be completely unpredictable. Security prices are similar. If there's good news the next day, the price will step up. And if there's bad news on that day, the price will take a step down. If you could systematically predict the arrival of good news after some observable event, then the price would go up more when that event was observed, but not when the news was actually coming out. When the news actually came out, people would say that it's not news. Rather, it's old news, which is already reflected in the current price. Okay, so that's what a random walk is. You go up and you go down randomly. Price changes are not predictable. But what about the average return? What if that is actually a significant number? Then what would that imply the prices would do over time? They would essentially drift up over time. That is, price changes would be positive on average. When the price rises in one day, it's likely to rise the next day. Is that a violation of the weak form? In spirit, no. The only extent to which the future return is predictable is by the amount that generates an average return that compensates risk-averse investors for bearing the risk over that period. With risk-averse investors, the weak form of the efficient market hypothesis essentially says that excess returns, those returns in excess of the average return to compensate savers, is unpredictable. That is, if we were to subtract the average return from each return, the return that is left over is unpredictable. You can predict that you will get a fair return by holding the security. You just can't predict when you will get a return that exceeds that return or is inferior relative to that return. If you could, then you would buy more before the return exceeds what you should get and sell before the return is insufficient given the risk. And by doing so, the price will rise before positive excess returns, which lowers that return, and will drop before a negative excess return, which will raise the return. Thus, by exploiting the predictability, your trades either moderate the effect or completely eliminate it. The weak form of the efficient market hypothesis states that active investors are active enough to eliminate the predictability in excess returns. And that means that on average, investors who just hold securities will earn a fair return, but not an excessive return. To put this into the context of the framework for investing we developed in Lecture 2, the weak form of the efficient market hypothesis implies that you cannot make any excess returns by plunging in and out of the market on the basis of what you can glean from past prices. If you hold a single index fund or an ETF that represents most of the market, you might be tempted to use that fund to time the market. If you think the market will fall, sell it and put all the money into cash. And if you think the market will rise, take all your money out of cash and put it into the market. The weak form of the EMH implies that you will not make any money doing that. In fact, given that there are transaction costs associated with such trading, the weak form says that you will actually lose money relative to what you could earn simply by buying and holding. So the issue is whether you can spot a pattern or not. So consider a chart that shows a time series plot of a year's worth of prices for a stock. Say go to any website and download the data. Do you see any patterns? If you do, you're not alone. But is there really a pattern? All right, so let's consider how we might detect predictability. So specifically, let's consider a plot of the return at, say, t against the return at t minus 1. So what we're going to do is on one of the axes, we're going to plot the current return, and then on the other axis, we're going to plot the return that occurred before that, or last period's return. On the plot, you can draw a vertical line emanating up from the horizontal axis to indicate the average of last period's returns, the lagged returns. Any return from that period that was bigger than this average will be on the right of the line. Anything to the left corresponds to returns that are lower than average. Similarly, you could draw a line perpendicular to the vertical axis that indicates the average for the subsequent period's returns, RT. What would predictability look like in such a plot of data? If there is predictability, then you should have a scatter of data points that either trend up or trend down. For example, if you have overreaction to information, then you would have that which goes up comes back down, and that which goes down comes back up. A plot of RT against RT minus 1 that has a general downward trend in the scatter of data is consistent with the overreaction violation of the weak form. With this kind of scatter, you would see that when the previous return was above average, more often than not, the returns on the next day are lower than average. Similarly, when the prior return is below average, the next day return will be above average more often than not. Furthermore, if we calculate the average of the returns for the next day for different ranges of last period's returns, we see that the lower the last period return is, the higher is the average the next day. In contrast, a scatter plot with a general upward trend is considered consistent with an underreaction violation of the weak form efficiency. That is, what goes up continues up, and that which goes down continues down. So let's return to the plot of the prices on your randomly selected stock. Did you see a pattern? Do you see a pattern? I've done this with students at the university, by the way. I'll show them a scatter plot, but this is actually a scatter plot from data that I have created using a process that has no predictability in. Most of my students will say that they actually do see a pattern. And then I will show them a plot of RT against RT minus 1 that proves that there is no pattern. The data are evenly distributed throughout the plot. There's no upward trend or downward trend. If the last period's return is high or low, then the next day's return is equally likely to be above or below its average. There's no predictability. By the way, most people end up arguing with me when they look at the level of the prices. They see patterns in the level of the prices. So this illustrates that plots of price level can be really hard to interpret. Maybe more accurately, they can be easy to over-interpret. So what is the empirical evidence about the weak form? One of the reasons of the University of Chicago is associated with the EMH is because of Professor Eugene Fama, one of the fathers of modern finance. Professor Fama was particularly adept at computers back at a time when a computer less powerful than the one that typically sits in your lap took up whole basements of large academic buildings. Because he was so adept, he was the first to do the monumental task of systematically looking to see if there was any predictability. And at that time, he found none. More recently, as computing power became cheaper and more convenient to wield, closer looks at the data have shown some predictability. In fact, there is not much argument about the existence of predictability. However, there is significant argument as to whether this predictability represents predictability in excess returns or whether it is predictability in the variation in fair returns. Okay, let's move on to the next form. There's the semi-strong form of the EMH, is that available information includes past prices and returns and any public information. For example, whether Procter & Gamble or Gillette are going to merge. This is less weak since prices have to reflect that which is reflected under the weak form, plus any additional public information. The semi-strong form implies that you cannot make excess returns using a trade strategy that reacts to public announcements of events or policies. For example, as an example of a violation of the semi-strong form of efficiency, might entail the announcement of a corporate policy such as a dividend cut. Let's say the firm announces a dividend cut. At the announcement, the price declines. But on average, the price gains half of that drop back in the next week. Given this rebound, you can make money by buying after dividend cuts. Buy low and sell higher on average the following week. If there is a violation of the semi-strong form efficiency, then the market must not be valuing the implication of the announcement accurately. In this example, there's an overreaction. An underreaction to an event will also produce a violation of the semi-strong form efficiency. For example, if the price of a publicly traded firm falls immediately after it announces that it is going to sell more equity, that by itself would not constitute evidence of a violation of the semi-strong form. But if the price on average continued to fall for a year after the announcement, then the reaction at the announcement must not be efficient. There was an underreaction on average. Okay, now let's consider the strong form. The strong form of the EMH is that in addition to the stuff that should be reflected under the semi-strong form and the weak form, it must also reflect private information. If markets are strong form efficient, even insiders cannot make trading profits by trading on inside information. This is called the strong form because it seems very unlikely to hold. In addition, the strong form also implies that right after the decision to adopt a given corporate policy is made, but before it's actually announced, the impact of that policy will be reflected in prices. There is some evidence that some of this information does leak out into prices. This is probably because of insider trading. While although illegal, still does happen. There's actually something very ironic about the strong form efficiency. Although it would be great to have prices fully efficient and reflect everything, in such a world, there is really no incentive to collect costly information in the first place. If a person cannot profitably trade on his or her superior information or analysis of value because the price reflects that information before they can trade, then no one will engage in that kind of activity, and prices will actually be less informative on average. This is called the Grossman paradox, named after Sanford Grossman, the professor who pioneered the way we think about information in security prices. The good news is that no one really thinks that markets are strong form efficient. The point of this lecture has been to discuss the implications of market prices reflecting information about value. It is often said that an economist knows the price of everything, but the value of nothing. The question examined here is whether there is at least a theoretical case to be made that prices might equal value. In the next lecture, we'll examine the empirical implications regarding this theoretical case.